Welcome to another edition of Heartwood Financial Services Monthly Review. This is Dimo Gonzalez, President of Heartwood Financial Services. Thanks again for joining us, and a Happy New Year to everybody. I have a great video set up for you guys today. I hope you enjoy. It's been a pretty good run for the markets, so we have some exciting numbers and stats to show you. As a quick reminder, there's going to be essentially two versions of this video. If you watch the first 8 minutes or so, you'll get the quick version. If you stay tuned, there's going to be an extended version for those of you that like a little bit more details. So I hope you enjoy. Okay, let's kickstart the video with the asset class returns. On the left here, you can see large cap stocks had a pretty great year, up over 30% for the year, up 3% for the month of December. Small caps did very well, up 3% for the month, 22+% for the year. And real estate did very well too. Real estate up 29%, beating small caps, almost eclipsing the large caps. Didn't have as good of a month, but still 1.3, not too shabby. But the big surprise here is the international stocks. First of all, for the year, they haven't done quite as well. But for the month, as you can see here, led the market. 3.67 for developed, 6.74 for emerging markets. More of that to come in the video. So fixed income, 7.57% for fixed income, investment grade, higher quality bonds. That is a banner year for fixed income. Not so great for December, but still positive. But again, for the year, that is a great year. And then we have high yield. High yield, this is the junkier, lower quality type bonds. They did very good this year too. 16.4 is a tremendous year for high yield bonds, and still up decent for the month. And then lastly, we have commodities. That's gold, wheat, oil, things of that nature. You can see it's up 10% for the year and got half of that just in the month of December. So if you stay tuned, I'm going to talk a little bit more about why this happened. A lot of it has to do with the Fed and the trade talks and things like that. So you'll hear more about that. But it's a pretty good year overall. Okay, so here is our market update. Now, this is more than just for the month of December. This is probably more of a recap for the year, as you'll see. 2019, a complete 180 from 2018. That's probably an understatement, right? Right at the end of 2018, market dropped about 19% that month. Everybody was very nervous about a recession coming. We had the yield curve getting close to being inverted, and it later got inverted in 2019. So everybody was very concerned about recession. The Fed was hiking rates. So that was kind of the bottom of things. And as you probably noted, I was encouraging everybody to hang in there and not to panic, trying to be a little bit more positive. And as we see, there was a massive turnaround in 2019. Now, a lot of this came as a spark from the Fed doing a 180. Okay, they did a 180 from going from tightening to lowering interest rates. And this makes a big impact on the economy, makes it easier for loans, for borrowing, for banks. And so that has made a big difference. And then towards the end of the year, we've also seen a big change in the rhetoric coming from U.S. and China and the trade talks. As you guys have probably seen from the news, it looks like we're going to be signing a phase 1 deal with China here potentially in the next week or so. Now, you might say phase 1, Demo, that doesn't sound like a lot's really happening. And that might be true. Nobody really knows exactly what's in the details quite yet. And I don't suppose it's going to be earth-shattering, but the change is that we're at least cooperating. We're getting together. We're making a deal. Tariffs have been removed. Not all, but some. And so just that change in attitude and sentiment has had a very positive impact on the markets. You also see here that the leading indicators, which again are looking forward, not just looking at what's happened in the past, are still looking pretty stable. Now, we would hope to see them get a lot better, although we've seen some signs of hope in some of them. Others have actually gotten a little bit worse. So I would call this kind of just staying stable. So that remains to be seen if things start turning around in the leading indicators of the economy. That would be, again, a very good sign that are more good times to come. The one thing that I want to point out here as well, though, is the valuations and sentiment are very high. I'm going to be showing you some slides about this on the extended version, but stock market prices right now are at about 19 times earnings, forward earnings, and that is historically pretty high. The average is around 16. And a lot of that has to do with, folks think that earnings are going to be a lot better next year. Although I would argue that we've priced in pretty much all the earnings growth that everybody's already projected. So how much more can we go? And then when sentiment is very high, we're essentially have everybody very excited about the stock market. That also makes me a little weary. So I'm being very cautious in this environment. As the market ticks up, I'm taking a little money off the table just so we can make sure to capitalize on these gains. The yield curve not inverted anymore. Okay, so remember about the yield curve in the middle of last year, the doom and gloom that came with the inversion. Remember, the inversion is when the longer term interest rates are lower than the shorter term interest rates. Now everything is back to normal, although it's still very flat. So when we get a flat yield curve where basically the interest rates are the same across the board almost, that shows that we're stable, but not a lot of growth is expected globally. And so that might be because of growth. It also might be because, again, Europe has a lot of negative interest rates and Japan has negative interest rates, and they're coming over here and buying our bonds that keeps interest rates low artificially. So that's been a big debate, among economists for the last year or so. And lastly, as you all know, you've seen the news with Iran. It's pretty scary what's been happening with Iran. It looks like things are calming down a little bit. Iran had to show a little show of force. Luckily, there wasn't too much harm done. But my fear is they're not done. What's overt might be done, but the covert is what we're probably going to expect some more of. They do have abilities to do cyber attacks and things like that. So I think there's going to be more of that to come, and so that could add a little volatility to the markets. Okay, and for the outlook, we're going to be stay invested but limit downside risk. You may notice in some of the portfolios I've been basically staying the course with the stocks, but adding a little bit more to gold, adding a little bit more to Gateway and some of those funds that use some hedging strategies to protect from the downside. And for my most conservative clients, I'll be talking to them later. I'm going to be adding something else that will also add a little bit more potential for downside protection. We also have looking for opportunities outside of the U.S., especially the large caps. I think there's going to be some good opportunities there as the valuations get a little stretched here in the U.S. And the trade wars start to simmer down. I think it's going to help global growth, and it's especially going to be helpful for the international stocks as they're a little bit better in value right now, and their earnings growth will increase. There could be some opportunities there. Election year likely to add volatility. As you all know, we're in an election year, and just the uncertainty of who's going to be the president makes people a little anxious. We potentially have some candidates on the Democratic side that are sounding a little bit more socialistic than in the past. So that's got some people a little bit nervous in how that could affect the economy. If a more centrist type Democrat wins the candidacy, I think the market might see that favorably. Of course, if Trump wins, the market will probably like that since he's been pretty pro-business. But again, a lot of this is up in the air. I probably wouldn't put too much emphasis on this because even during election years, most of the years are up rather than down, no matter who wins. So that'll be interesting to see, but just another variable to keep an eye on. And finally, just a continued neutral stance. We're going to stay pretty much right down the middle lane with the portfolios going forward. Okay, if you have any questions, email me, call me. Be happy to help. The Secure Act is passed. It is now the law of the land. So how is this going to affect me? Well, first of all, the Stretch IRA is dead. Now, the Stretch IRA, as a quick reminder, is if you have an IRA, you can name your kids as a beneficiary. Now, maybe you make them a contingent beneficiary after your spouse. But if you and your spouse were to pass away and your kids inherit your IRA, they can stretch the withdrawals over their lifetime. That has been eliminated. Okay, so now it's been changed to a 10-year period, and that's going to, obviously Congress wants more of your money, more of your tax money quicker. So that's what's going on there. Please give me a call. There's a lot of things that we may want to discuss and review because of that change. Now, if you do have one of these beneficiary IRAs, let's say you were one of those children and you inherited one of these, you are grandfathered in, so you don't have to take it out quicker than you are. They did also change the required minimum distribution rules, where before it was 70.5, you had to take money out of your IRA. They changed it to 72, giving you a little extra time. That's nice. Also, if you have an IRA and you're over 70.5, before you weren't able to add to it anymore. Now you can. Of course, you have to have earned income. And finally, more annuity options in retirement plans. People for a couple decades now are complaining how pensions are going away. And annuities can essentially be like a pension. And so some of these options, they're trying to figure out how to add more of these types of features and options in those retirement plans. So we'll be interesting to see how that develops. But that is the Secure Act. And for the last part of the video, just wanted to talk about how this time of the year is a time for New Year's resolutions. And first of all, I have a funny little joke here. My New Year's resolution was going to be to quit all my bad habits, but then it occurred. Nobody likes a quitter. Put that in there to emphasize that I'm not going to be telling you to quit something. What I want to encourage you is to do something. We're calling it the money mission statement. So essentially, it's a declaration of the family's long-term goals, attitudes, and beliefs about money. It can serve as a powerful tool offering a framework for families to structure conversations around money and wealth with each other, ideally lasting through future generations. So imagine if you had a money mission statement. You could show it to your kids, you could show it to your CPA, you could show it to me, your attorney, and what a difference it would make if they know exactly where you're coming from and what your long-term goals for you and your family are. So that's the idea behind the money mission statement. I'm actually going to be working on one myself here the next few weeks. If you'd like to share yours with me, feel free. We can collaborate together, and hopefully it'll be a good experience, and it'll be something that you can use as a tool with your family in the future. So thanks again for tuning in. This is the end, and I hope to see you again next month. If you have any questions about anything, let me know. If you'd like to share this video with any of your friends, feel free to do so. God bless. Bye-bye. Okay, welcome to the extended version of the monthly review video. If you're still watching, that means you like to get into the details. So I'm going to get a little bit more into the details on some of the comments I made in earlier parts of the video. This is a chart of the S&P 500 charted over a 2-year period. I'm using a Yahoo Finance charting website. And as you can see, right at the end of the year, it was mostly in December, we had a pretty big drop. A lot of that was we were starting to get more concerns with the trade war, but it was especially about the Fed and the fact that they were raising rates. So we had, all this friction in the economy at the time. And then what you can see here is at the beginning of 2019, we had a huge comeback. And a lot of that was because of the Fed U-turn. You heard me talk a lot about that at the earlier part of the year. So they started talking about cutting rates, and then they started cutting rates. And as you can see here, about 50% of the returns on the S&P 500 last year mostly came in the first few months of the year. Because what happened after that, the market kind of bounced around for about 4 months or so, pretty flat. We had a lot of concerns about recession. We had the inverted yield curve. The trade talks weren't going very well. And so you had a lot of people that are actually going at more and more conservative. You had a lot of advisors talk about going into bonds, and we actually saw huge flows into bonds during that time. And as you can see now with 2020 vision, is that it was a pretty big mistake because the market just continued to climb and actually had a banner year. Now, what finished off the huge run was obviously the Fed continued to cut rates and stayed on hold. And also we have some positive movement with the trade talks between U.S. and China. So that was very promising. And of course, right at the end too, we even had that big vote in England about Brexit, and making it a lot clearer that they would probably have a Brexit, and it would be right at the beginning of 2020. So that clarity, along with the clarity from the trade talks, along with the clarity from the Fed, really is what amped up the market here in the last quarter of the 2019. Okay, here is the leading indicators. As you can see from the chart I've shown here before, on the top we have the economy growing. On the bottom we have it contracting. On the right it's expanding, and on the left it's declining. And so as you can see, the red square here, which is the medium of all coordinates, is still pretty much in the same spot it was before. This was basically in the growth category, but kind of slowing down. And again, when we get into the rectangle here, that is when usually a recession is getting ready to happen. That's when the market starts to correct. So we still have a little room there. There's been some things that have gotten better, like consumer sentiment, existing home sales, but then other things that have gotten a little bit worse, like the ISM non-manufacturing, industrial capacity utilization, things like that. So it's still kind of a mixed signals. We're hoping now with the trade deal in place and a little bit more optimism that we'll start to see some positive movements in these leading indicators. But this is something that we'll certainly be keeping a close eye on. Okay, so you heard me talk about how I thought the market was pretty fully valued. Well, you have to look at the math of the market to really realize that this is happening. So again, this is a chart that I've created of the S&P 500. Today's date, current earnings estimates at 163. If you look at the earnings estimates for the next 12 months, I use two very reliable sources. We're at about 170 and a half. That would be about a 4% earnings growth. Okay, with that kind of earnings growth, using an average PE ratio of 16.2, and I've even added a little multiplier to that due to the fact that we have a very low interest rate environment, that means we should be at about 3176 in the S&P 500 by the end of the year. Now, we're already at 3270. So when you add the dividend of 1.75, that's an expected return of about -1. That's why I think the market's a little expensive right now. So one of two things is happening. Either we're due for a small correction that's going to bring the stock prices down back to more where it should be, or the earnings growth is going to be a lot higher than people expect. Now, there are some analysts out there that are talking about earnings getting into the 180 range. And if it does get to that, that would be very good news. That means we would have earnings growth of about 10%. With earnings growth of about 10%, now we're looking at a positive return for the S&P 500. But we're not looking at a huge return. We would have to get earnings growth to get anywhere near what we got in returns this year to go up 16%. Now, we haven't seen earnings growth like that since 2017, right when we went from not having tax reform to tax reform. So I just don't see that happening. The more realistic number is maybe in that 180 range. Maybe this China trade pact does get the global economy going, and it really oils the gears of the economy globally, and it helps the United States. And I hope that happens, and this is something that we'll be keeping a close eye on. But for right now, until I see those earnings numbers come out and meet and beat expectations, I'm going to be a little bit cautious because, as you can see, at 170, which is the current expectations, we're looking at a pretty flat return for the rest of the year. Now, not to get too pessimistic, this is just the S&P 500. There are lots of opportunities, I feel, outside of the U.S., and I'm going to get a little bit more into that in one of the detailed slides here in a minute. Now, I mentioned valuations being high, but sentiment is also very high. And when sentiment gets very high, that's usually when I start getting a little bit more cautious. Now, one of the indicators that I look at for sentiment is this one here called the Fear and Greed Index. This is an index created by CNN. It actually has many, many different components. You can look it up yourself. Right now, this is really at the end of the year, it was in the 90 range. Right now, it's actually even a little bit higher than 91. You can see where it's been really in a year ago. Amazing, it was at 8. But as you can see, and the history has shown that when the indicator gets really high, that's usually a good time to get a little bit more cautious. And when the indicator gets really low, like it did a year ago, it's a good time to get a little bit more optimistic. And so as you can see here, the sentiment is really not on our side as well. And again, this is for the stock market, and mostly people are looking at the the U.S. stock market. I also mentioned how the yield curve is not inverted anymore. Again, that's the longer term rates are now a little higher than the shorter term rates. And this is the difference between the two. When the longer term rates get lower than the shorter term rates, you can see that it goes into the negative. And usually, as you can see here, that's been a sign of going into a recession, as you can see by the dark gray bars. Currently, we're right here, and we have bounced up. Now, in the past, we do bounce up before we get to a recession. So that is an interesting thing to look at. Now, usually it bounces up because short-term rates go up too much and we invert. And what's happened now is the short-term rates have gone down. So I think this time could be a little different. It could be maybe a little bit more of how it was in the 90s here, where we got close to inversion and actually inverted a little bit in the late 1990s, and then the market still bounced. But as you can see, we did eventually go into a recession, but it was several years later. And that might be what we're experiencing right now. Of course, this remains to be seen, and this is something to keep a very close eye on. But it's yield curve not being inverted anymore is not necessarily an all clear. Okay, and for the last slide, I mentioned some opportunities maybe outside of the U.S., and I talked about valuations. Now, the tricky thing with valuations is they are a good indicator of what's going to happen long term, but in the short term, sometimes the market can run hot, as we've seen over the last several years with large cap growth. But this is very interesting from a long-term perspective. As you can see here in the U.S., this bar here shows the historical range for the PE is this purple, and where we are in this is little blue diamond. So we're higher than we have been historically. In the developed markets, also the same, but not quite as far. This is Europe. Europe is basically right at its historical average of prices. So valuations is about normal. Japan, Japan is very cheap. You can see currently it's way below its historical normal range. And emerging markets, one of the ones that I've mentioned before, emerging markets is also cheap. You can see currently the blue diamond is below that purple band. And so it's cheaper. So we have good earnings growth potentially coming out globally with China and the U.S. getting along better, and maybe some clarity with Brexit. So if you look at some of these areas that are cheaper than the U.S., you can see how there could be a potential for a better return in those areas. And so I'll be definitely keeping an eye on that and making some strategic changes as that develops.